it's all coming apart. Everything was highly correlated, but now, as you can see from this chart, realized stock correlation is now at its lowest level in 5 years, actually far longer than that. Hi, Courtney Smith here with our weekly TradeSmith newsletter. Let me get back to this thing right now. So what this means and why this is important. You see, we either have a stock market or a market of stocks. And what we've been doing is we've been in a period now where we have a market of stocks. So the stocks are not correlated with each other, and there's some are going up and some are going down and some are going sideways. Other time periods, we end up with a stock market where all the stocks go up together and they go down together. I like it when we have a market of stocks, because then what that means is our superior stock picking ability can come to the fore and we can make extra money. Anyway, let's dive right into it. Dive right into this, of course. I'm sure you have it memorized by now. Okay. Last week I told you the market was about to pop. And the market did pop. Now, I'm not so sure this is going to pop much further. First of all, we got the pop. Maybe we'll get a little bit more follow through, but look at the purple predictor. The purple predictor popped, and then it moved right back into the trading range where it was before. The price up top did not drop into the trading range, so we have a divergence here. The purple predictor is a good leading or coincident indicator for the market. So I think this pop might be running out of gas. And I'm not ready to say we're going to move into a bear move or something like that, but it sure looks like we're about to move back into the trading zone that we were in, at least in the S&P 500. But as I said, we're in a market of stocks, so each one of the major indices has a slightly different look. Let's take a look at the Dow Jones. Now, this is longer term. We got the pop exactly as I told you. In the box up above, now I told you I was a bit worried because the ADX crossed over, the green cross down below the red line up top. Now we've seen the green line move back up above the red line, which is bullish. But you'll see that the RSI did not move to a new high, so we have RSI divergence. Well, what does that mean? What it means is that the market is not going to see follow through on the upside. So we got the pop. RSI is saying, you know what? You're going to have to sag back down a little bit. So it looks like we're going to see the Dow drop back into the trading range as well. Let's try the NASDAQ. A little bit different situation here. I think the action's going to be over here. Notice the purple predictor, quite strong. No big problem there. That's the purple line. Look at the green line. No divergence here in the NASDAQ. So I think what we're going to see is we're going to see NASDAQ type stocks outperform the big industrials. This is the theme we've been pounding on here for a while. Domestic stocks, not international stocks. And the international stocks, the S&P and the Dow Jones are dominated by stocks which make a lot of money overseas. Half the profits of the S&P 500 come from outside the U.S. Well, excuse me. I should have a cough button or something here, but what the heck. All right. Now, seasonality, sideways. If it goes up above that green line, I'm going to consider getting in again. I'm going to consider, that we should even up our exposure more. Excuse me. But if it breaks the red line, we got to get into hunker down mode. We got to go from, say, bigger than normal risk to a smaller than normal risk. I think we beat this to death the last few weeks, so let's carry on. Nothing new here. Asset allocation, on the other hand, is showing some bullishness. What we're seeing is money flow out of the bond market and into the stock market. This is one of the reasons why we got the pop. I'll show you bonds in a minute. But you can see right here, the money flew out of the bond market and into the stock market, causing the pop. Our risk indicator, however, is not following through on the upside with the stock market. It's saying that they still are pretty nervous about this market and they still want to be conservative. Global shares have actually outperformed the U.S. stock market now for about 3 weeks, something like that. The U.S. stock market kind of went sideways, but global shares have started to perk up. Now, it's kind of a mixed bag out there. You know, some countries are going up, some are going down. But I like the Greek stock market. GREK is the ETF that mimics the Greek market. This is called an ascending triangle formation. And if it breaks the high at 830, I want to be long. I want to be long. Now, I'm already long the Greek stock market, but I would add to my position if we break the high of 830. The other one that I like is the Japanese market, and it did break to new highs. Last week I told you if it broke to new highs, I would get long. So this is another place that I want to be long. Japanese shares are going to be one of the best markets in the world this year. Now, let's take a look at bonds. I told you that money flew out of the bond market, and you can see that the market came under pressure here. I think we're going to go lower, but this is not going to be a dramatic drop. First of all, we don't have RSI divergence, but if the bond market made a new low, it would probably be divergent. So we want to be short. But this is going to be a sluggish bear market in the bond market. We're going to see interest rates move higher, but it's going to be in a sluggish manner. Let's take a look at our indicators. Starting last week, all of the indicators are saying higher interest rates. This is one of the major reasons. What are we talking about? We're talking about gold. We're talking about the dollar. We're talking about 10-year treasuries overseas in the German market. These are three key indicators that tell us where bond yields are going to go. Bond yields are going higher. Take my word for it. And that's going to have a big impact on the dollar. Now, I'm getting more and more bulled up about the dollar. I think that the dip is over. And I think that we're going to move higher right now. I think that Thursday was the low of the move. And the reversal bar that we saw on that day was the low of the move. Couple reasons why. First of all, interest rates are moving higher. That makes the US dollar more attractive than other currencies. That's not from a fundamental perspective. The Trump effect. The market, the world believes that the U.S. economy is going to accelerate with the decline in taxes and the decline in regulations. If the U.S. economy gets stronger, and I also believe that it will get stronger, that will increase the attractiveness of the dollar. From a short-term technical perspective, we've got a downtrend line. That's the downward slanting line there. And but look down at the bottom. That horizontal green line shows that while the dollar was going down in price, the RSI was going sideways. In other words, the internal dynamics of the dollar were getting more and more bullish, even though the price is going down. So look for the dollar to rally now. It started on Thursday. It's going to continue to move higher. Well, if the dollar moves higher, then gold is going to go lower. Now, gold's already started to go lower. Now, last week, one of the critical things was I started to get bulled up. I admit, I didn't say buy. I was going to stay on the sidelines. Thank goodness. Because look at what's happening here. Our indicators were 3 greens last week. Our 3 technical key indicators were all bullish. But has the yen moved down there, down at the bottom? I kind of put a squiggly thing there. And the other 2 are barely bullish. I mean, they're not particularly accelerating rapidly to the upside. So it looks to me like we're going to consolidate gold right now. So the best thing to do is to stand aside. Oil, this has been my nemesis here. Fortunately, I haven't traded it. But you can see we're just not going to, I just don't see how we can make new highs. I just don't see it from a fundamental perspective. I just don't see it. Demand is not there yet, okay? And supply can be turned on at a moment's notice. I'm going to stand aside until the picture is clear. Technically, it's obviously in a trading range. I don't trade trading ranges. I want to make big money. Big money's made on a big move, so I'm going to ignore the oil market. Hey, freebies, love having you here, but you know what you need to do. Fully paid up members, hang on just a second. Got some new trades for you.